I'm Chris Preston.
And I'm Brad Simmerman.
Welcome to Street Check, the best two-person podcast in the history of Cabot Wealth Network. Brad, bananas have been in the news lately. This morning, President Trump said that he is lowering tariffs on bananas to lower the price of bananas. As our producer Madison just pointed out before we went on air, the Savannah Bananas are holding their first player draft. Savannah Bananas are like that baseball team that sells out every stadium no matter where they go. It's like the Harlem Globetrotters of baseball. You had a banana story. I don't know if it's interesting, but you were talking about you ordered a banana or something recently.
Yeah.
Talk about that.
Uh, I paid $17 for a banana. So
That's
here's
why Trump's lowering the lowering the
yeah.
tariffs on them.
Here's the deal. The banana that everybody eats today, the common banana that's like 59 cents a pound and has been forever, is the Cavendish. That is the dominant cultivated strain globally. Up until the 50s, the dominant strain was the Gros Michel, which was wiped out commercially by like a fungal disease, Panama disease, I think it's called. Um, I have always heard that the banana candies, the reason that they taste much different from like an actual banana is because the original flavor is based on the Gros Michel and not the Cavendish with which we are also familiar. But I did find this company called Miami Fruit that grows like weird, not weird, that grows more tropical fruits and like seasonally unavailable fruits and will send you Gros Michels. You can buy cocoa, like cacao beans from it. I actually have a box coming from them today with cacao because I've been wanting to try it. But I have a Gros Michel banana that is ripening in my kitchen right now. I always thought that I would never have a chance to actually try it. I was not aware that there are still small commercial operations that are selling it.
Yeah, I totally knew that we were all eating Cavendish and that Gros Michels were a thing. I definitely knew all of that. That was the Brad Knows Things corner of the podcast. That's specifically for Jacob Mintz, our colleague. Um, $17
Uh,
for a banana. Well,
it's
hope it's
well,
good.
it's the what was that show where they had the banana stand? I can't think of it. Arrested Development. It's the Arrested Development meme. Like, what could it cost? What? It's a banana, Michael. What could it cost? $10? Yeah, well, apparently it
Yeah.
could. I'll give a taste update
Yeah,
on
we'll need a report
next
on that.
week's episode. Will be,
Okay.
hey, Gross Michelle's same as every other banana, not worth $17.
Okay. Yeah,
We'll see.
everyone will be on their edge of their seat for that one. Okay.
Banana
Let's
Watch 2025.
what's that? 2025?
Banana Watch
Banana
2025.
Watch. Yeah, yes. Okay, let's shift to investing. What are we going to talk about today?
We are going to talk about growth stocks crumbling a little bit to, well, really just the middle of this week. Talk about the end of the government shutdown, healthcare stocks booming. Michael Burry shutters Scion Asset Management, his hedge fund. And then the White House floated a bunch of ideas that might feasibly benefit consumers. But before we get into all that, it is your week to defend the hottest take you can think of. This week, Dow outperforms the NASDAQ through year end, and that's a good thing. You have 90 seconds and you may begin.
Yeah, so we've sort of seen that shift the last few weeks. The Dow actually, for all the problems the Nasdaq, S&P have had the last few weeks, the problems in those indexes have been fairly minor, but under the surface, growth stocks have really been kind of imploding, which we'll get to. The Dow just hit a new all-time high like 2 days ago. It did pull back. It's pulling back a little bit more today than the S&P and the Nasdaq, but this is because, the air has sort of started to come out of the balloon of the AI trade a little bit, mostly I think due to valuation concerns and, the romance phase for AI has passed. I don't necessarily think that the bubble is here, or the bubble popping is here for AI, but, there's a cooling off period that's happening. And as that's happening, people are rotating into the more sort of defensive stocks or, really 7 of the 11 sectors were undervalued, are undervalued, more or less undervalued on a forward PE ratio basis than the S&P. And so there's a lot of undervalued stocks out there, defensive type stocks, and people are rotating into those. And so I think even if the Nasdaq and S&P stall, pull back more into year's end, if the Dow is the one that's up, I think your portfolio is going to feel pretty good as long as you're fairly diversified.
5 seconds. No, we'll call it there. Um, all right.
I had 5 seconds left, or
Yeah, you had 5 seconds left.
okay. All right,
Uh,
well, here, let me expand.
no,
Um, you know, unless you have a portfolio full of AI related AI, big tech related plays, um, you might not have felt this pullback all that acutely the last few weeks. Now, maybe you do have all those, which is why we always say diversify. But, more defensive type names, value stocks are up. The Dow is up 2% in the last month versus NASDAQ 1.6%, S&P 1.3%. Um, the Mag 7 are down 6% last month. So I think it's a good thing that the Dow is up. We needed the sectors that have been carrying us, tech, basically big tech, AI, this year needed a cooling off period, and there are plenty of unloved sectors out there. And the Dow isn't a perfect measure because they have some of their own big tech, increasingly more of their
no.
own big tech Mag 7, but um, it's a better measure than the Nasdaq, that's for sure.
Yeah, with the Dow, like Amazon is in there, Microsoft's in there.
Yeah.
So obviously there's some exposure. Um, I guess we should probably talk about growth stocks
Yeah, let's
crumbling and
rotate into
then
it. Yeah.
quickly snapping back today, it looks like. I was looking at Oracle. They're up 3% today, but in the last month down 25%,
Yep.
right? Like that's obviously a major AI play. A lot of the high flyers have been the ones to suffer disproportionately. CoreWeave is one that was a really popular play earlier this year. They're down 40% in the last month.
Yeah.
Um, so I don't know.
The Nasdaq is the Nasdaq's down a little more than 4% from its late October highs. The Investors Business Daily 50 FFTY ticker symbol, which is measuring stick for growth stocks that Mike Santolo, our growth expert, uses. He was on here last week. More than 15% off of its late October highs. That's like in 2 weeks. I mentioned the Mag 7 down 6% from their highs, from its highs. And even small caps, 6% down. But yeah, growth stocks and AI plays in particular have had a rough first half of November.
Well, so looking at the last month, Nasdaq's up 2%. Nvidia is up 5.5% in the last month, right? So even with the
Yeah, in the grand scheme, the pullback isn't that bad. It's just been a tough couple months, or a couple weeks, I should say.
the thing that I keep sort of waiting for or looking for is like a blow off top.
Yeah.
Like we haven't had that yet. It looked like maybe October was gonna do it or was gonna start us in that direction. But all I think really all that we've seen is that we backed off some of that like end of October exuberance when everybody was pretty much locked in on additional Fed rate cuts and basically liquidity to the rescue. And since then, we've sucked some of the exuberance out of the balloon.
Yeah. And part of
Is
that
what it
is
feels like.
probably has to do with the rate cuts. It's now a 50-50 proposition as to whether they'll cut again next month, at least according to the, trusty Fed Watch tool.
Yeah, I think I'm on record saying I didn't expect him to cut, but we'll see. That was months ago. I have
I'm going to
no
say they
idea.
will, but it's good. Yeah, it's good that we have a disagreement.
It'll be tough to, I mean, they're flying blind a little bit
Yeah.
with the data blackout from the government being shut down. Who knows? We've seen like some private sector stuff come out and show employment that's seems a little bit weaker than expected, but it's been kind of mixed signals. So with the Fed saying data dependent for so long, that puts them in a little bit of a bind. Um, and I think maybe the markets are pricing that in a little bit because like even today we're bouncing back. We found support where we should, which was like 66 on the S&P.
Mhm.
Um, and we're up over 6,700 again. Right now, the S&P is at 67.56. So we've
Mhm.
had an intraday bounce of 100 points today. Um, Maybe it's a dead cat bounce and like we keep going lower, but that's not my base case. I think that we're still in that sort of longer term. I mean, the intermediate term, like 6 month bull market we've had off or rally we've had off the April lows, and then that longer term bull market. I think we're still in that formation technically, and I don't know, maybe I'm doing myself a disservice as a bear to say like, well, I'm waiting for a blow off top before I'm ready to call it. But even with the selling the last couple of weeks, this isn't screaming the end of the bear or the end of the bull market to me.
No, no, I don't think that either. I think frankly we needed a pullback, maybe even a correction. We're not in correction territory. Um, Although maybe in growth stocks, we're there. But a couple things. You know, the equal weight index, as I mentioned last week, is still basically has not budged since 4th of July. So that's why this has been, very the second half of this post Liberation Day rally has been very thin. It's been, Mag 7 and AI driven, um, at least until this month. And then speaking of this month, as I also mentioned a few weeks back, throw out the calendar. Um, I think because of the interest rate cutting, Fed rate cut schedule, um, I don't think the sell in May go away. That didn't matter. Clearly, if you sold in May and went away, you missed out on a lot of great potential profits because those are great 6 months for the market. And, November through April is traditionally the best 6 months for the market. And we're not off to such a great start here in November. It doesn't mean we won't bounce back. November, December are traditionally the two best months for the market, or two of the best months for the market. And they might not be that way this year. And that's all right. I think things are going to come down more to valuations and to rate cuts and the economy.
Yeah, it's tough to. I mean, like obviously the seasonality stuff seems to be out the window, right? Like October
Yeah,
historically being a bad month,
right.
and
This is a
that
good month.
obviously has not been the case even in this
September too.
correction. Yeah. So I mean, maybe we get like an inverse. Maybe November, December end up being terrible months, and we get like a Krampus rally or a Krampus bear market instead of a Santa rally.
Yeah.
Um,
Well, like I said, it was what, 2018 when then the market bottom on Christmas Eve and it was like close to a bear market. Um, yeah, we've had this, and that was under the same administration as now. So, you know, could
yeah,
happen
the
again. I don't think we're swinging to a bear market, but correction. Are we headed towards correction? Maybe.
yeah the tough thing. I think maybe we go to Michael Burry next.
Hmm.
So he shuttered Scion Asset Management, which was his hedge fund. Um, there is the thing that I cannot escape. There is this saying that bull markets don't end until the last bear throws in the towel. Um, there's a little bit of a sense of that being maybe in play, where it's like, all right, he
Yeah.
gives up. Um, but
It's
the
funny. A
quote
week
that
ago, we were talking about him like
yeah,
making these big bearish bets, and this is almost like taking his ball and going home. Like, all right, fine. If you're not going to sell, is it Nvidia and Palantir? Were those the two?
yeah, those were his
I
two
mean,
that
they
he
have been sold off, but maybe not quite to the degree that he might have thought. And he's like, okay, if you guys aren't with me, I'm taking my ball and going home. Anyway, go
so
ahead.
there was one specific quote from his letter. It started circulating online a couple of days ago, announcing the closure of Scion, that I wanted to call out. This is quoting what he had written. My estimation of value in securities is not now and has not been for some time in sync with the markets. The the market for it seems like for I don't know, certainly the last 4 years maybe the last 10 years, basically since we had like the change to a liquidity regime and like easy money from the Fed and rate cuts and QE and all that stuff. The traditional like function of the market has sort of been thrown out the window. Um, in the past, if a company was poorly run and was losing a ton of money, if you're a smart money trader or a hedge fund guy, you identify that valuation mismatch, and then you short the company into the ground and it goes out of business. And the shorts make money on that. Um, that doesn't happen anymore, right? Like what ends up happening is retail investors get wind of major short positions in a company like a GameStop or an Open Door, and they start engineering their own like counter play
Yeah.
where they end up driving up at the cost of hedge funds, which I don't know. I'm agnostic. I don't care about hedge funds. But at the cost of hedge funds, they end up running up these what are effectively zombie companies, like non-viable companies. Um, I do think I think the acknowledgement from Burry in shutting
We'll
this
never
down
know.
is that yeah, nobody can know.
Yeah.
Um, is that the sort of liquidity regime that's in place now, the everything bubble that I think we're still in, you can't, maybe he should have evolved with the times, but I mean, like, what am I supposed to do if by any typical valuation measure, something like Tesla, I'll call Tesla out specifically just because we're both very familiar with it.
Yeah,
I don't
please.
have anything against it. But
Yeah.
like Tesla shouldn't trade at 200 times earnings.
Right.
Nobody should trade at 200 times earnings unless it's like they've just developed a cure to cancer. And the only reason they're trading at 200 times earnings is because they're pre-revenue, but literally
Right.
every biotech factory in the country is spinning up like this cancer vaccine. Somebody like that can trade at 200 times earnings. Somebody like Tesla that's in the business of like operating in the real world and selling vehicles and power walls and robots, there's no justification for them to trade at that level. The only justification is that you have this overload of liquidity in the market that fundamentally breaks the way that I think a lot of, I don't even want to say older traders because he's not that old, but a lot of guys that maybe come from before the Great Recession, the the way that they operated doesn't really function in the market as it exists now. Um,
Yeah. Yeah. I mean,
so
as the famous Jesse Livermore saying goes, markets are never wrong, opinions are.
yeah,
You've been
and
wrong for
Keynes,
years. I mean, if you're just screaming into the wind at a certain point, you know, that is like, oh, but those valuations, you know, like maybe this is the new normal. Might not always be, but in a bull market, this probably is the new normal.
yeah, Keynes said markets can remain irrational longer than you can remain solvent.
Yes.
And that's what Burry ran up against, I think. Like I don't I came up as a broker in the '07, '08, '09 Great Recession era. Um, and Bruce Kaiser, who was a Cabot analyst, used to run Cabot Value Investor, was
Yeah.
one of those sort of classic value guys.
Yeah.
And I don't lamented sounds like he's, you know, uh, has a negative connotation that I don't want to convey, but he sort of lamented the underperformance of like value stocks and traditional value investing. Um, will this go back to normal? I don't know. Like maybe this is the new normal.
Maybe
If
it's been
we're in just
15
like
years that growth stocks have outperformed value stocks, basically since the Great Recession.
yeah, and that's also coincides with the rise of like passive investing, where something like the SPY, it buys based on how big something is, not by how well run the business is, right? It's market cap weighted. So the
Yeah.
bigger something gets, the more money chases it. The bigger it gets, the more money chases it. The bigger there is a cycle to it. This is all to sort of bring back to our prior conversation. I don't know that this changes until something breaks.
Right.
Um, that is the thing that has me maybe leaning more permeable right now. is like even the AI bubble, that's not, at least right now, not at risk of breaking something. All of the money being plowed into AI right now is coming from hyperscaler free cash flow. It's not like we're, at least publicly disclosed, it's not like there's tons of debt building up to support this bubble where there's going to be this, where all of a sudden we discover that the bottom has been sort of pulled out from under the capital structure of these data centers. No, it's just hyperscalers burning free cash flow to build data centers to burn energy to power AI that isn't really adding anything to the economy. If that stops, okay,
Yeah.
right? Like it doesn't do anything. It just it removes growth, but it doesn't pull the bottom out from under us. So I don't know, and I think this probably goes hand in hand with me looking for like a blow off top. I don't know um, when the guys like Michael Burry are going to be right again, but I don't think any of us are going to see it coming. Um,
Right. Yeah. And look, we've had we've had bear markets even the last few years. I mean, we had two bear markets in the 20s already, and I think yeah, each decade averages two. Um, maybe it's three, I can't remember. But obviously the COVID crash was quick, was painful but short. And then the rally after was for the next almost 2 years was spectacular, a year and a half. Then 2022 happened. Real, pretty painful, almost year long bear market. This April, NASDAQ technically entered bear market very briefly on Liberation Day or right after Liberation Day. Small caps did too. Um, so it's not like I think the recoveries are much quicker. Like their old rule used to be like there'd be a a double bottom kind of a thing, and usually V-shaped rallies are rare. And now it seems like they're all V-shaped rallies, you
yeah,
know. And maybe that's because, well, now maybe because of like the sort of the AI tailwind. But maybe that's in a sort of a more tech-driven world. The upside of tech is too enticing for people after they've sold off a certain amount. I don't know.
yeah. I think at the end of the day, I'm always going to come back to liquidity. There's just too much money circulating around right now, that's
Yeah,
chasing stuff that exists only for speculation. Bitcoin, right?
yeah,
Bitcoin cracked below 100,000 again, still
yeah.
$97,000 a token. Okay, what justifies that valuation? Well, nothing.
Nothing.
It is essentially a financial figure that's being attached to like carbon creation. It's like the opposite of uh, like a carbon sink credit. Like,
Yep.
and AI is maybe a little bit the same way. And I guess to remove sort of the ecological effect on that, it's just your ability to burn compute has a dollar value attached to it. That
Yeah.
is consistent with AI, and that's consistent with crypto. Is it's just your ability to burn compute. We're attaching a dollar value to it. That screams to me that there's too much money circulating, and it's not, things are just sort of untethered from where what would have typically been like value drivers, like improved productivity, improved quality of life, um, selling goods to people in the real world. And maybe it's just a side effect of us being terminally online, I believe is the
Yep.
terminology. Um, but yeah, I'm not, I don't know.
Yeah. So long, Michael Burry / Barry. We'll never know your name or how to pronounce your name. Next up, government shutdown is over. Uh, Record long government shutdown, 43 days. Market was up during the shutdown, not a lot, but it was up. It was October 1st, right? It was the beginning of October. And even with, we were on here when it started. We're like, I think after a certain point, maybe it'll start to impact the market. And I guess you could argue maybe that it did, but I don't know that I don't know that the shutdown had a whole lot to do with what's happened to the market in November because it didn't. The second it ended, there wasn't like this big rejoicing moment among investors, at least that I could detect. Um, airlines have been and airports have been directly impacted. It's been a nightmare to travel, apparently. Thankfully, I have not done so recently. But even airline stocks aren't down that much. Um, did the government, what did Wall Street treat the government shutdown with a collective yawn, shrug?
Yeah, but I think mostly rightly so. The Office of Management budget estimated that the 42-day and 22 hours, so 43-day shutdown was responsible for 0.8% drag on GDP, which is roughly half of the GDP growth that we had in the first half of the year. But they expect that to recover fully with back pay going out. The big loss is to like government contractors whose jobs are just paused and they don't get back pay.
Yeah.
But the permanent hit to the US economy is estimated at $11 billion. That's it. That was the cost of shutting the government down for 43 days, at least to like the total US economy. But Wall Street has always, or at least previously always favored sort of split governments where
Hmm.
Congress or the Senate are of divided parties, or Congress and the Senate are on the opposite side of the White House because they don't get in the way. They don't do anything.
Yeah.
So government gridlock is good for the markets in general. I don't I don't see any reason why this would have been any different. I mean, especially since everybody just sort of white knuckled it and
Yeah.
carried on. It didn't really hit consumer spending that much, aside from some furloughed workers and military members and stuff like that. But that's not really what the market's measuring.
Yeah.
Is
And 0.8% inflation adjusted gross domestic GDP lost during the shutdown, according to the accounting firm EY. Economy grew by 1.6% in the first half of the year. So, in essence, this 43 days wiped out the first half of the year's, or half the first half of the year's growth. But, you know, a lot of those losses will probably be recovered once government workers are back to work and get their back pay. And, in theory, that should make for, November, December always are usually good for the market because of, Black Friday, holiday shopping season, etc. Um, in theory, that should make for a good holiday shopping season. But, the psychological damage done is revealed, and consumer sentiment is at 50.7, which is the lowest reading since 2022. So, psychologically, damage may have been done. I I don't know. Maybe there'll be, you know, some sort of ramifications for the market from the shutdown, whether good or bad, or whether we'll know them or not. I don't know. I guess if sentiment improves now the shutdown's over in the coming months, people are getting their back pay. Um, then we'll see, okay, that this really put a real dent in, sentiment. Um, but right now it kind of feels like for the market, certainly not for people who are affected by it, for the market specifically is kind of, you know, no harm, no foul kind of a thing, which is a very, cavalier way to talk about it, but it feels that way.
Yeah, the market. I mean, the market doesn't care. Like, okay, so I think I had said OMB gave those estimates. No, that was EY, like you said. OMB, I think, was the 11 billion figure that I had as total loss. But 11 billion lost for good. Okay, well, OpenAI burnt $11 billion last quarter
Right.
on AI, right? Like
Yeah.
when we are looking at the sort of relative impact, nobody even blinks about that figure. Um, so why would it have why would that kind of loss have a disparate impact on the market as a whole? Um, I mean, I think that the K-shaped economy thing I have talked about for years, that's
Hmm.
still in play. individual stocks will show the effects of lower consumer spending. Chipotle, right? Like that was a stock market darling for years.
Yep.
And in the last month, they're down 25%. In the last year, they're down 47.8%. In the last 5 years, up 25%. So they've lost almost half their value in the past year. That is where consumer sentiment is hitting,
Yeah.
is companies like that, companies like Wendy's. There is probably a critical mass where all of those sort of like aggregate consumer underspending consequences stack up enough where it really matters again for Wall
Mhm.
Street. I don't know where that is. Like I don't what's the tipping point? It's like, okay, well, McDonald's just had a bad quarter, I think. Disney just had a rough quarter. Like all these consumer facing stocks, they are all feeling the pain of the lower leg of the K-shaped economy. Meanwhile, like the headline indexes are rallying on the higher leg, which
Right.
is the AI spending, the hyperscale investment, all that stuff.
Right. Okay. Real quick before we get to our next topic, I want to tell you about our offer today. If you go to cabotwealth.com/street, we are offering Nancy Zambell's Cabot Money Club, which is a monthly newsletter that has a stock of the month uh, aspect embedded in it. We're offering it for 75% off the normal price, just $49 for the year. That's like, a couple trips to Wendy's or Chipotle to use something we just talked about. Um, 30 day 100% money back guarantee if you want to try it out for a month, see if you like it. But again, it's $49 just for the year. What you get is monthly issues, Money Club issues from Nancy Zambell, who's been in the industry for decades, is really good at breaking down sort of personal finance issues, which she does in her Cabot Money Club magazine. And she also has a stock of the month portfolio where she interviews a Cabot analyst every month and has picks from various Cabot analysts. You also get premium reports, a richer retirement, and ETFs, an easy way to build a lifetime investment portfolio. So again, go to cabotwealth.com/street to get 75% off the normal price of Cabot Money Club. $49 for the year. Like you'll probably make that back and then some. Okay, let's shift on a more positive note. Let's shift to a sector that has been doing well the last month. That's healthcare stocks. They're up 7.5% in the last month. Easily the best performing sector uh, among the 11 major S&P sectors. Next is energy at 4.8%. S&P is up 1.2% during that time. Healthcare is kind of a law of averages thing. It was the worst performing sector for most of the year prior to this. It's sort of been in the dumps for about a year or more. But as Tom Hutchinson, our dividend expert, has written ad nauseum, healthcare is something everybody needs, and they need more of it because of the aging of the population. Baby boomers, one of the largest generations, is now at the age where they need extra healthcare, and it feels like it was inevitable that investors would eventually sort of spot a deal with healthcare stocks. What else do you see behind the move? And do you think this is beginning of a longer rally in healthcare stocks?
I Yeah, I like healthcare over the long haul.
Yeah.
I mean, Tom has made a case for it. But, look at something like the GLP drugs are still
Mhm.
widespread. I believe those are going to start being covered by Medicare and Medicaid,
Yeah.
is something that I believe the White House floated recently. We are seeing innovative developments with all kinds of medical technologies. Like there is that is where like the sci-fi exciting growth of technology stuff that I pine for sometimes is actually happening. I think there was a recent discovery that um, things like rheumatoid arthritis and a lot of widespread autoimmune issues are all tied to maybe a single virus, right? Like these discoveries also happen to go hand in hand with something that AI is really good at, which is pattern recognition. it is this weird sort of confluence of really high demand across the entire population, especially the affluent population, right? Boomers have the biggest share of wealth, plus these new technologies. Um, I like healthcare as sort of like the cutting edge place to be right now, as more so than anything that is consumer facing tech because of the issues we just talked about with the consumers. Yeah, I like healthcare as an I like an overweight position in healthcare right now.
Yeah.
There's also you can get some decent dividends,
You're right.
long-term care facilities, right? If you're looking for like a REIT angle, there's some attractive opportunities there. I think that is the place that is probably the most exciting. And I think narratively also it's a good place for the market to go once some of the hype on AI cools.
Yeah. I mean, it's a real thing that, again, everyone needs. And, I think healthcare I've liked in theory for a while, but as, Mike and others at Cabot have talked about, it's hard to guess about them. And also that the most bullish thing that a stock or sector can do is for the chart to start going up. And that's what's happening. So, you don't want to be late to a rally like this, but it's still early enough. It's just really just the last month or so, where, good time to hop on board. And it's still, the sector is still the fifth most or lowest valued of the 11 sectors. Forward price to earnings ratio of 18.7. The market average right now is 23. So still undervalued. And yeah, I think healthcare, no matter when you buy, is almost always going to be a good 5, 10 plus year investment. And I think the timing right now is about as good as you can find in terms of, the stocks have been knocked backward for a long time, but now are really starting to gain traction. It looks like the beginning of a potentially longer run.
Yeah, just to put some numbers underneath that as well. XLV, which is the healthcare ETF, it's 3% below its 2024 highs.
Yeah.
XBI, which is biotech, which is an area that I'm more interested in, 30% below 2021 highs, and it's up 55% almost from the April bottom.
Wow.
So that one has been moving a lot this year, but I think it still has more room to run. Biotech I like more than just like general. So I guess if I was going to get specific on
Yeah.
my allocation, I'd be more inclined to look at biotech, especially as people are continuing to sort of spend money freely.
Yeah.
In
That's the
a recession,
growthier way to
yes,
play healthcare. Yeah.
yeah, in a recessionary environment, or if money becomes harder to come by, biotech is really costly. So you can't run all these new drug discoveries and all that stuff because you're just hemorrhaging money, waiting for drugs to sort of pan out. That said, like the other edge of that coin is, well, if you can automate a lot of like these trials, hypothetically, like if you can run like a protein sequence, run like 1,000 different iterations of it using artificial intelligence or general or generative artificial intelligence or anything like that, if it allows you to do some of that sort of iterative work up front, you could maybe see a lot of meaningful cost savings there. I don't think we're fully there yet, but that is where I think you have a lot of potential right now for this Venn diagram of like automation tools and biotech and like medical discovery could be like a game changer.
Yeah.
So I think XBI if we stay in a bull market and XLV if that cracks maybe.
Yeah. Yeah. XP is a good one. All right. Last thing. There's been a couple ideas floated out from the White House to improve things for the consumer, maybe spooked by the last week's election. Can't call it a blue wave when it was like 3 elections, 4 elections, maybe like more like a blue ripple. But we mentioned, banana banana tariffs being lowered to lower the price of bananas. That was just this morning, but also the idea of a $2,000 possibly dividend check or some sort of rebate to help to every American household to help offset the cost of tariffs. And now talking about 50-year mortgages to help improve the real estate market. I don't know how much this is moving the needle. It might be a believe it when we see it kind of a thing. Will we see it? What's your take?
So I want to start with the 50-year mortgage thing. That there have been 40-year mortgages kind of as part of like a rescue plans. So there's the institutional infrastructure in place to like package and trade longer than just a 30-year conventional mortgage. But from a practical standpoint, the thing I want to float is more cautionary, I guess, with a 30-year mortgage, $400,000 home, 10% down, versus a 50-year, you save about $250 a month with a 50-year mortgage, but you end up paying 86% more interest. So instead of paying $440,000 in interest on a 30-year loan, you end up paying $817,000 of interest on a 50-year. So
Hmm.
like, don't get a 50-year mortgage.
No.
The other thing is like if you're putting less than 20% down, you're paying PMI for a lot longer because the first like 10 years are essentially just interest only. The interesting or one of the interesting things about some of these ideas that have been floated, the tariff rebate checks seems to uh Scott Bessent, the Secretary, the
Yeah.
Treasury Secretary.
Yeah.
Um, the first time the president floated the idea of like a tariff dividend check, he was on some news network saying, well, when he says dividends, he just really means the benefits. So through like things like tax cuts. And then the president doubled down on tariff rebate checks, and Dissent came out and said, well, maybe it's only for households making less than 100,000. So there actually does seem to be a little bit of pushback on some of this ruling by fiat that we have seen of late. I can't imagine how they can justify any dollar amount of tariff rebates. A 2,000 or a $2,000 check per person is like,
Yep.
that's 300 million people. What's that times 2,000? Uh, it's
Six.
600 billion, right?
Yeah.
Yeah, so it's
Yeah.
it's far more than we've collected. It's like four times the amount that we've collected in tariffs. There's no
Yeah.
way to do it on a per person basis. If you do it on a per household and you cap it at like 100,000,
So it was per person, not household. Was that?
well, that's the
I don't
thing.
know if it's I don't know if it's been fully fleshed out.
No, it is not fully fleshed out. The president is talking about doing it. He seems to be locked in on the uh bailout, the tariff bailout checks to everybody because I think everybody really liked that during the
Yeah.
pandemic.
Yes.
So like his impulse is the popularity one, and then the sense
And
like,
that was
well,
good for for the market.
for a little bit, yeah.
Yeah. For a little.
Um, and then but Bassett is a little bit more grounded in the real world, and he recognizes that throwing $500 billion out there when this money is allegedly already going to be used to pay down debt and fund the government and do all this other stuff. I think something comes of it. I don't know what exactly.
Two
I think
dollars, two
maybe you
hundred
do
dollars.
like if you did $1,000 a household, that's all the revenue, or it's 70% ish of the revenue that's been collected from the tariffs.
Hmm.
And we're already seeing commentary that maybe some of these tariffs are going to fall off for some of these goods for which there's really not a replacement. Coffee. We really can't grow coffee in the US outside of Hawaii. So that is one that we have pointed out, that everybody's pointed out,
Yeah.
where you can't justify tariffs on it in the first place. Bananas, beef, right? Like, I
Yep.
mean, beef tariffs actually kind of make sense if you're protecting the U.S. domestic beef producers.
Yep.
I think they're looking for something. They're going to latch onto something. I don't know which one of those it is. I think the checks is the easiest one for the president to get behind. Some
Yeah.
sort of.
Yeah. We'll see. Um, yeah. And like I said, I think the market will believe it when they see it, when it's there's like a signed uh legislation behind that, or that's become official. Okay, well, I think we've talked long enough. I think that's a podcast, don't you?
Yeah, how many times have you talked about bananas? Half dozen? That seems like
One for
seems
each, one for every banana you usually get in how many do you usually get? Do you break up the bananas at the grocery store into a smaller amount, or you just grab all of them and say, I think we can finish these before they all rot?
no, I get like three at a time or four tops if I'm getting
Okay.
them.
So you're a break them in half kind of a.
No, I will not break them. I will just identify the one that has already been broken up, and if they don't have one
Oh,
that's
I
already
see.
been broken up, I'm a skip.
Okay. Yeah. I go for like 6, 7. You're really playing with fire beyond 6.
You can't be eating like a banana a day. That's too many bananas. You get potassium radiation poisoning from all the potassium or whatever.
Yeah, but I mean, family of 4,
I guess.
which we both have. Okay. Well, thanks for everyone for indulging us on the latest episode of Street Check. We will be back next Friday, and we promise not to talk about bananas then. But as
No,
always,
we
like and
we
subscribe.
don't promise that. I have to give a banana taste update on the Gross
Oh, that's
Michelle.
right. Yeah, excuse me. Yeah, I can't promise we won't talk about
No,
bananas.
you cannot.
All
The
right, we
one
will
thing I
talk.
promised to this episode is that I would bring it up again.
Excuse me. All right, so we'll be back next Friday for all your investing and banana talk as usual. And we will talk to you then.